The reset just happened. After weeks of carnage, after billions in speculative positions were liquidated, after leveraged traders were flushed out and weak hands capitulated, the precious metals market has undergone a structural reset. And while most investors are still processing what just happened, still licking their wounds, still questioning whether they should have ever invested in gold and silver, the smart money is already looking ahead. They're not watching price. They're watching something else entirely. Because here's what institutional investors, central banks, and sophisticated traders understand that most retail investors never learn. The crash wasn't the event. The crash was the preparation. What matters now is what happens next. And there are exactly 5 signals that smart money watches after every major precious metals reset. 5 indicators that have preceded every significant move for the past 50 years. Not technical analysis, not chart patterns, structural signals that reveal where big money is actually flowing. These signals are publicly available. You can access them yourself. But almost nobody knows where to look or how to interpret what they find. By the end of this video, you'll understand exactly what the smart money is watching right now, why these signals matter more than price action, how to access this information yourself, and what the current readings are telling us about what might happen next. Because in markets, information asymmetry creates opportunity. Most people watch price. Smart money watches structure. And after a reset like this one, structural signals become more valuable than ever. Welcome to the silent economy. Let's examine what the smart money is watching. Let me introduce you to the 5 signals that smart money monitors after every precious metals reset. These aren't secret. They're not behind paywalls. They're publicly available data that most retail investors simply don't know exists, and they reveal what's actually happening beneath the surface price action. Signal 1. Commitment of traders' positioning. Every week, the Commodity Futures Trading Commission publishes data showing exactly how different categories of traders are positioned in gold and silver futures, commercials versus speculators, managed money versus producers. This data reveals extremes. When speculative long positions reach historical highs, crashes typically follow. When speculative positioning reaches washed-out lows, rallies often emerge. After a reset, smart money watches how quickly speculative positions rebuild. Slow rebuilding suggests a prolonged base. Rapid rebuilding suggests either a quick rally or another washout ahead. Signal 2. Central bank purchasing activity. Central banks have become the largest structural buyers of gold in recent years. Unlike speculators, they don't trade in and out. They accumulate for reserves. Their buying represents persistent demand that absorbs supply. The World Gold Council and various national reporting agencies publish this data. After a reset, smart money watches whether central bank buying continues, accelerates, or pauses. Continued strong buying during price weakness is historically bullish. Signal 3. Physical versus paper. Market divergence. During normal markets, paper futures prices and physical metal prices track closely. During stress, they can diverge significantly. Smart money watches premiums on physical coins and bars relative to spot price. They watch delivery requests at COMEX. They watch inventory flows at major depositories. When physical premiums remain elevated despite paper price weakness, it signals that real demand exceeds what the paper market suggests. This divergence has preceded significant rallies historically. Signal 4. Real interest rate. Trajectory gold has an inverse relationship with real interest rates. Real rates equal nominal rates minus inflation. When real rates are negative, holding gold has no opportunity cost. When real rates are positive and rising, gold faces headwinds. Smart money doesn't just watch current real rates. They watch the trajectory. Are real rates rising or falling? What's priced into the bond market for future rate moves? The direction matters more than the level. Signal 5. COMEX registered inventory levels. COMEX is where gold and silver futures trade. They maintain inventory categorized as registered, meaning available for delivery, and eligible, meaning stored but not available. Registered inventory levels reveal how much metal is actually available to meet delivery requests. Declining registered inventory during or after a crash can signal that physical demand is absorbing available supply. Smart money, Watch as these inventory trends closely. Sharp declines in registered inventory have preceded significant price moves historically. These 5 signals together create a comprehensive picture of market structure that price alone cannot reveal. Let me show you how these signals have worked in historical examples. Example 1. The 2008 reset, October 2008. Gold had crashed from $1,000 to $680. Silver had been cut in half. The financial system was in crisis. Yet precious metals had crashed alongside everything else. Let's examine what the 5 signals showed after that reset. Signal 1. COT positioning managed money. Long positions had collapsed. The speculative excess that built through 2007 and early 2008 was completely unwound. Positioning was at multi-year lows. Commercial short positions had decreased dramatically. The market was structurally reset. Signal 2. Central bank activity. This is when the historical shift began. Central banks, which had been net sellers of gold for decades, began transitioning to net buyers. The central bank gold agreement that had governed European sales was losing relevance. A new accumulation era was beginning. Signal 3. Physical versus paper. Divergence premiums on physical gold and silver coins exploded. The U.S. Mint suspended sales of certain products due to overwhelming demand. Physical buyers were paying 50% or more above spot for silver eagles. The divergence was extreme and sustained. Signal 4. Real interest rates. The Federal Reserve had cut rates to zero. Inflation expectations remained positive. Real rates went deeply negative. The opportunity cost of holding gold had become negative. You were essentially being paid to hold gold versus holding cash. Signal 5. COMEX inventory. Delivery requests increased significantly. Registered inventory saw notable drawdowns as physical demand intensified. All 5 signals aligned bullish after the 2008 reset. What happened next? Gold rallied from $680 to $1,921 over the next 3 years. Silver exploded from $9 to nearly $50. Those who understood the signals captured generational gains. Example 2. The 2015 reset, December 2015. Gold bottomed near $1,050 after years of decline from the 2011 highs. Silver languished near $13. Sentiment was devastated. Many declared the precious metals bull market dead. What did the signals show? Signal 1. COT positioning. Speculative positioning was washed out but not at extreme lows. Some managed money. Long positions persisted through the decline. The reset was incomplete compared to 2008. Signal 2. Central bank activity. Central bank buying continued but at modest levels. Russia and China were accumulating, but total volumes were lower than what would come later. Signal 3. Physical versus paper divergence. Physical premiums were normal. No significant divergence between paper and physical markets. Demand was present but not urgent. Signal 4. Real interest rates. The Fed had just raised rates for the first time in nearly a decade. More hikes were expected. Real rates were rising. This signal was not supportive. Signal 5. COMEX inventory. Registered inventory was stable. No significant drawdowns suggesting supply stress. The signals in 2015 were mixed. 2 or 3 supportive, 2 or 3 neutral or negative. What happened next? Gold did begin recovering, but slowly. It took until 2019 for gold to break above $1,400 convincingly. The rally came, but the mixed signals correctly predicted it would take time. Example 3. The late 2018 reset, August 2018. Gold hit a low near $1,160 after months of decline. The Fed was raising rates aggressively. The dollar was strong. Gold looked terrible technically. But let's check the signals. Signal 1. COT positioning. This is where it got interesting. Managed money net positioning actually went negative for the first time in recorded history. Speculators were net short gold. This had never happened before. The reset was beyond complete. It was historically extreme. Signal 2. Central bank activity. Central bank buying was accelerating. Russia, China, and others were purchasing at increasing pace. Structural demand was building. Signal 3. Physical versus paper divergence. Physical premiums remained healthy. Coin and bar demand continued despite price weakness. Signal 4. Real interest rates. Real rates were positive, but the Fed was signaling that the rate hiking cycle was maturing. The trajectory was about to shift. Signal 5. COMEX inventory. Registered inventory was declining. Physical metal was being withdrawn from exchange warehouses. The signals in late 2018 were strong, particularly Signal 1, the unprecedented net short speculative positioning. What happened next? Gold rallied from 1,160 to 1,550s over the next 12 months, a 33% gain. By 2020, it had exceeded $2,000. The signals identified the opportunity when price looked worst. Example 4. The March 2020 reset. March 2020. COVID panic. Everything crashed. Gold dropped from $1,680 to $1,250 in days. Silver collapsed to under $12. The signals after that reset were the most aligned in modern history. Signal 1. COT positioning. Leveraged positions were liquidated across the board. Managed money, long positions dropped dramatically in days. Signal 2. Central bank activity. Central bank buying continued uninterrupted. They viewed the crash as opportunity, not threat. Signal 3. Physical versus paper divergence. Physical premiums exploded to levels not seen since 2008. Silver eagles were selling for $10 or more above spot. Gold coins carried premiums of $100 or more. Physical demand was overwhelming while paper prices crashed. This divergence was historically extreme. Signal 4. Real interest rates. The Fed cut to zero immediately. Launched unlimited QE. Real rates went deeply negative essentially overnight. Signal 5. COMEX inventory delivery requests surged. Inventory stress appeared. The physical market was tightening rapidly. All 5 signals flashed strong buy simultaneously. What happened next? Gold hit new all-time highs above 2,075s within 5 months. Silver more than doubled. The fastest post-reset rally in modern history. The signals worked. Every time. So what are the 5 signals showing right now after this reset? Let me walk through each one with the most current available data. Signal 1. COT positioning. Current status. The recent crash significantly reduced managed money net long positions. Speculative excess that built during the rally to all-time highs has been substantially unwound. Is it at the extreme levels we saw in late 2018 when specs were net short? No. But meaningful reduction has occurred. The market is lighter than it was. Current reading. Moderately bullish. Reset occurred, but not to historical extremes. Signal 2. Central bank activity. Current status. Central bank gold purchases have been running at record pace. Over 1,000 tons annually in recent years according to World Gold Council data. China, Russia, India, Turkey, Poland, and numerous other nations continue accumulating. Critically, the crash has not interrupted this buying. Central banks view price weakness as opportunity. Reports indicate continued purchasing through recent volatility. Current reading, strongly bullish. Structural demand remains robust. Signal 3. Physical versus paper. Divergence. Current status. Physical premiums have increased during this crash, but not to 2020 extremes. Silver coin premiums have risen. Gold coin availability has tightened somewhat. Dealers report steady demand. The divergence exists, but is moderate. Physical demand is present without being panic-driven. Current reading. Moderately bullish. Physical market is absorbing paper weakness. Signal 4. Real interest rates. Current status. This is the complex signal currently. Nominal rates remain elevated. Inflation has moderated from peak levels. Real rates are positive. However, rate cut expectations are priced into markets. The Fed has signaled that the tightening cycle is mature. The trajectory appears to be shifting from rising to stable to eventually falling. For this signal to turn strongly bullish, we need actual rate cuts or clear deterioration in economic data forcing Fed accommodation. Current reading, neutral to slightly bullish. Trajectory more favorable than level. Signal 5, COMEX inventory, Current status. COMEX registered gold inventory has declined notably over recent years. Silver registered inventory has seen significant drawdowns. The trend has been persistent. Less metal available for delivery against futures contracts. This suggests physical demand is absorbing warehouse supply. Current reading, moderately bullish. Inventory trends, supportive. Overall signal assessment, signal 1, moderately bullish signal. 2, strongly bullish signal. 3, moderately bullish signal. 4, neutral to slightly bullish signal. 5, moderately bullish 4. Of 5 signals are reading bullish to some degree. Only real interest rates remain a headwind, and even that signal shows improving trajectory. This configuration is stronger than 2015, but not as aligned as 2020. It most closely resembles late 2018 or the period following the 2013 crash. What does that suggest? The conditions for a significant move are developing. The timing remains uncertain. The setup is constructive, but patience may be required. Smart money is watching these signals closely. Now you can too. Let me address the obvious objections. Signals can be wrong. No indicator is perfect. Absolutely correct. These signals don't guarantee outcomes. They improve probability. When 4 or 5 signals align, historically good things have followed. When signals are mixed, outcomes have been mixed. This is probability enhancement, not certainty. The goal is to make decisions with better information than price alone provides. The data is backward-looking. COT reports are delayed. Central bank data comes out quarterly. True. But these signals measure structural conditions, not timing triggers. Whether central banks bought last week or last month, the trend reveals their strategic positioning. Whether specs added contracts Tuesday or Thursday matters less than whether positioning is extreme or washed out. Structure changes slowly. That's why it's valuable. Everyone has access to this data. How can it provide an edge? Everyone has access to company financial statements too. Most people don't read them. Everyone can access academic research on markets. Most people don't study it. Information that's public but underutilized still provides advantage. The edge comes from doing the work that most won't do. Why not just watch price action and technical analysis? Technical analysis tells you what has happened to price. These signals tell you about market structure, positioning, and physical demand. They reveal different information. After resets, technical analysis often looks terrible. Signals can look constructive. The signals are leading indicators. Price is a lagging indicator. Here's how to implement this framework yourself. First, set up weekly COT tracking. The CFTC releases data every Friday. Find a resource that visualizes this data or learn to read the raw reports. Track managed money positioning in gold and silver. Second, follow central bank purchasing reports. The World Gold Council publishes quarterly demand reports. Various central banks report their reserve holdings monthly. Create a simple tracking system. Third, monitor physical premiums. Check major online dealers weekly. Compare coin and bar prices to spot. When premiums spike, pay attention. When they're normal, note that too. Fourth, track real interest rate trajectory. Follow Fed statements, inflation reports, and bond market pricing of future rates. The direction matters more than the level. Fifth, watch COMEX inventory data. This data is published daily. Focus on registered inventory trends over weeks and months rather than day-to-day noise. Sixth, create your own signal dashboard. A simple spreadsheet tracking all 5 signals with your assessment of each. Update it weekly or monthly. This creates discipline. Seventh, act when signals align strongly. Exercise patience when they don't. Multiple signals pointing the same direction increases confidence. Mixed signals suggest caution and smaller positioning. This is the silent economy. The reset has happened. Speculative excess has been cleared. And while most investors are focused on price, wondering if the bottom is in, smart money is watching these 5 structural signals. Now you know what they're watching. The current readings suggest constructive conditions are developing. Not the extreme alignment of 2020, but more favorable than the mixed picture of 2015. The setup is building. Whether the next move comes quickly or requires patience, you now have a framework for evaluating conditions that most retail investors never develop. That's an edge. Use it. If this analysis gave you tools you didn't have before, subscribe and hit the notification bell. Next week, we're breaking down the specific central banks accumulating gold most aggressively, what their purchases reveal about their economic outlook, and what it signals about the global monetary system's direction. Drop a comment below. Tell me which signal you think is most important right now. Which are you going to start tracking? I read every comment. Markets reward those who look deeper, who study structure, not just price, who understand what most ignore. That's the path. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.